Well, hello, everyone, and welcome. This is Cynthia Tamain with Interactive Brokers, and thank you for joining today's webinar being brought to us by GreenTraderTax.com as well as Green Neuschwander and Manning LLC. Now, before we do get started today on how traders can save taxes before year end, I do want to introduce our presenter today, Robert Green. So, Robert, thank you for joining us, and for today's event, let me go ahead and pass you the controls, and let's get underway here today. Thanks for joining us, Robert.
Thank you, Cynthia. Okay, everyone, let's get started. How traders can save taxes before year end. That means that you need to make certain actions and transactions before the end of the year. You don't want to just sit back, wait until you start preparing your tax return next year, because you may have missed the boat on several planning opportunities. Now, this year is especially complicated because we have the new tax law to consider, which kicked in for 2018. And there are many changes, some of which have not been widely publicized, and complexities. So you want to get started with your accountant early on. We can't work with all our clients, the last few weeks of the year. It's a good idea to start working with us in November, now, and December, so that we have adequate time to plan your taxes accordingly. That's if you care about that extra savings. And I know that many of you that are here do. So thank you for introducing me, Cynthia. I'm the managing member of Green Neuschwander and Manning LLC and CEO of GreenTraderTax.com. I'm considered a leading authority on trader tax. So those of you who know us know that there are general accountants and there are niche accountants. We provide services and content to the trader niche and investment management too. There are so many special and unique rules, and when you follow general practitioners, you don't get that kind of coverage that you need. I'm the author of Green's 2018 Trader Tax Guide. I've published it every year since 1997. The current edition discusses the Tax Cuts and Jobs Act impact on investors, traders, and investment managers. I'm also a contributor to Forbes, and you'll see my content on the leading brokerage firms and financial media. The information today is educational. It's not intended for one-on-one tax advice. I'm encouraging you to contact us or your own CPA or tax advisor to get customized advice. I'm not affiliated with Interactive Brokers. We're a CPA firm and tax publisher. They're a brokerage firm. Today, we're going to discuss the 2017 Tax Cuts and Jobs Act, otherwise known as TCJA, and how it made major changes for the tax rules for individuals and businesses. You're a trader. If you're in the business of trading, you're a business, and those impact you. And they also impact you as an individual, like all those itemized deduction changes. So I'm going to show you how to use savvy year-end planning strategies so that you don't miss the boat. Now, it's sort of two parts. They stand alone. We have today, and then we're going to have another webinar on December 5th with a lot of unique rules just for traders. So we're going to cover a bunch today and then the rest later. My content tends to be in depth and sometimes overwhelming, so it's good to split it in two when possible. Let's get started now. In a general rule of thumb, when the tax rates next year are pretty much the same as what they are this year, why not defer income and accelerate tax deductions to this year? It's a time-honored strategy. Now you'll enjoy the time value of the money. So if you don't pay taxes this year because you defer the income to next year, not only do you save taxes in 2018 when you get ready to pay them on April 15th next year, but estimated taxes next year are based on a lower amount. So you're just pushing off tax money and getting to trade that money in the markets. So that's a time-honored strategy. The problem for traders is that they have volatility in income. Their year-end planning is a challenge. One year, they have $500,000 of income. The next year, they have no income. They have a loss. The year after that, they're somewhere in between. It's hard for them to have one strategy that works every year. This year, they may qualify for trader tax status. Next year, they may not, or vice versa. So it's more of a challenge. So if you're expecting to be in a lower tax bracket in 2019, you should consider the income deferral strategies. So if you had a great year this year and you know you're high, hey, you want to defer. But conversely, if you've had an off year this year, if you got hit with the volatility products at different times and you have some big ordinary losses with 475, and you're hoping to get back on your feet next year and have gains next year, you should consider income acceleration strategies. You want to actually move income into this year to soak up and use that standard deduction and more. Now, also, if you have trader tax status this year, that can be a fleeting thing. You may not have it next year. So if you have a shot at business deductions this year, why not get that new computer now before the end of the year while you can still deduct 100% of it? Now, don't assume that accelerating itemized deductions is also a smart move. So again, you're going to use the time-honored strategy to defer income and accelerate expenses. But it may not help to accelerate itemized deductions that no longer work for you. The new tax law suspended and curtailed various itemized deductions. So there is no sense in expediting a non-deductible item. Why rush to make a charitable contribution that you know you're using a standard deduction this year and you're not going to get the benefit? Why rush to pay an investment fee that's no longer deductible at all? Even with the acceleration of deductible expenses, many taxpayers will be better off using the standard deduction of $24,000 married, $12,000 single, $18,000 other taxpayers. If itemized deductions are below the standard deduction, you want to consider a bunching strategy. So maybe this year is the year that you didn't pay off your mortgage yet. You got the SALT cap of the $10,000 on state and local. You got $15,000 or $10,000 on your mortgage, so you're at 20 and you're married. So at $4,000 with charity, you'll get over the itemized deduction. So maybe this is the year you do a lot more charity. And then next year, when you know you're going to pay down the mortgage and maybe be further off the standard deduction, you won't do any charity next year because you're basically doing next year's charity this December. That's what I mean by bunching. Now, when would you accelerate income and defer deductions? The flip side of the time-honored strategy. Why would you want to do that? Well, a TTS trader with substantial ordinary losses from using 475 doesn't have a capital loss limitation. They may want to soak up the business loss. Now, in the past, they didn't want to do that. They wanted to have this huge NOL that they could carry back 2 years to get a quickie refund and replenish their trading account. Well, the new tax law repealed the NOL carryback. We were very upset about that. We fought hard for that. So now you have to carry forward an NOL to next year. So why not take advantage of some things this year? So when you have an NOL and negative taxable income, you're wasting that beefed up standard deduction. If you're married, you're throwing away $24,000. You're throwing away the lowest tax bracket at 10%, the next bracket at 12%. In those two brackets, 10 and 12%, long-term capital gains, if you sell some of your long-term holdings now, which some people are doing if they think there's a correction or a bear market, there's a lot of gyrations now going on because of the markets. But you might be able to manage your income to take advantage of the $24,000 standard deduction, take advantage of the lower tax rate of 10 and 12% and take advantage of the 0 rate on long-term capital gains. How do you do that? You can't just flip a switch. Well, if you're holding on to some winning positions in like investments, you've been holding some of the FANG stocks a long time. Some of you sold recently going into corrections and you have more capital gains taxes than you would otherwise want, but some of you haven't. And you may want to before the end of the year. It may be tax wise to do so. You need to know where you stand. Now, it's not just about those lower brackets. If you accelerate income, make sure that you stay under the AGI dependent levels for making an IRA contribution, getting a student loan interest, getting an education credit, getting a child care credit. There's all these thresholds, and you don't want to inadvertently go over that. So you're sitting on a lever. You can sell open securities positions that have embedded capital gains if you've held them for years. So it's not tax loss selling, it's tax gain selling. And you're doing it because you want to be tax efficient. You want to take advantage of everything this year offers to you and then start anew next year. One way to do an acceleration of income is a Roth IRA conversion. You're sitting with money in a traditional IRA account, you and or your spouse. Maybe you left a job and it's in a 401k and you can roll it over to a rollover IRA and then do the conversion. Well, when you convert, the conversion income is taxable in the year of conversion. And that is what avoids the 10% excise tax on early withdrawals before age 59 and a half. So you convert 100,000, that's taxable income. So you can bust up your IRA into pieces right now. It takes time to do it. You bust it up this month, and then you say, I want to convert 50,000 because that's going to soak up some of my losses, get me the standard deduction, get me the lower rates, keep all those AGI thresholds in place. That's what I'm going to convert. I'm going to put the whole 50K into a Roth IRA. I probably have no conversion taxes because I've taken advantage of all those things that were available to me. Or the conversion taxes are tiny. I can pay it from outside the plan. Now, there's one concern. The new tax law repealed the reversal option. If you did a 2017 conversion, if it didn't work out for you, you could reverse it up until the due date of your return. Why wouldn't it work out for you? Well, let's say it's nice to convert beaten down stocks. So if you have some beaten down stocks after this correction now, or recently, in your IRA, if you convert to a Roth IRA now, the conversion income is at the beaten down price. So if those stocks come roaring back with a year-end rally and then a Q1 rally, and I'm not giving market advice, I'm saying if you would get that growth, that snapback growth permanently tax-free for the rest of your life. Remember, with a Roth, the income that you take in retirement, or if you pass it to your children in death, it's all permanently tax-free forever. It's an incredible thing. So if you can check out from the restaurant now, from the traditional, and go into this tax-free restaurant that's permanently tax-free, it's a wonderful thing. Traders can really grow these Roth accounts. Now, some of you will say, well, Bob, I can't do it because my income's too high. That's wrong. The income limit only applies to when you make Roth contributions. Now, it's not just Roth IRA. There's also the solo 401k Roth where you can make much bigger contributions. So the contribution is not deductible, but the contribution and all the growth is tax-free. So think about where you stand with the market in your traditional plans. If now is a good time, if there's beaten down stocks, the reverse could happen. Let's say that you convert stocks that are highly appreciated. Well, you're converting it at a high price. And then what if it drops in price while it's in the Roth? You don't get the benefit of the loss in the Roth. So you want to try to do it with your beaten down stocks. So bust up your traditional IRA into two pieces, the beaten down piece, the appreciated piece, and then convert the beaten down piece. You don't have to do that just because you have a low taxable income. You can do it even with a higher taxable income. So again, selling winning positions is that lever that you have to switch on some acceleration to soak up the standard deduction and the lower rates. And if you're in that the lowest two brackets at 10 and 12%, it's like 38,000 single and 77,000 for married, the top 12%. So let's say you're a single trader. You left your job in 2017. You had a flat year. You didn't really make much. You had some stocks you could sell for long-term capital gains. If you sell just the right amount and not a penny more, the rate is zero. You can sell those long-term gains for zero. If you think there's a risk the market's at the end of a bull market cycle and there could be a bear market next year, some people say that with the Democrats getting the House. Well, this would be a great strategy for this year for you to get a zero rate on gains while they're here in your hand. All right, business expenses. That's always the golden goose. You're an employee. You're an investor. You don't have a business. You've always gotten the shaft in the tax code. And now the new tax law says, hey, we don't want you to deduct anything. Take this big standard deduction and take very few deductions. Make your life simple. Suppose you want those deductions. Well, your ticket is a business. You need a side business. One of the best side businesses, the one that we deal with, is a trading business with trader tax status. Then you're entitled to business expense deductions, home office deductions. The home office portion requires income except for the mortgage interest and real estate tax portion. That SALT cap of 10,000 on state and local, that does not apply to the home office portion. So if you want to keep track of all your SALT, state and local income tax, you want to keep track of all that so that you might have a bigger home office deduction. If you don't have income to unlock the other portion of it, because maybe you're a renter, then you can, excuse me for jumping the slides there, then you could carry over the rest of the home office to next year if you have trader tax status. So if you have trader tax status going into year end, I don't care what you do with your income acceleration or deceleration strategies. You want to accelerate business expenses to a year when you have the TTS, unless you know for sure you're going to have it next year. So the new law expanded the full expensing of business property. Traders can deduct 100% of these costs. I mean, you're talking $1 million limits. This applies to much bigger businesses. As far as a trader goes, you could buy all the equipment you want. I mean, if you have a lot of automation, you're probably renting cloud services. You're not even buying it. But you can buy all the equipment you want between full expensing, tangible property expensing, 100% depreciation. You're getting a full write-off. I mean, if you're using 179 depreciation, it can look to your or your spouse's wages or the business income. You're probably going to get it all as a deduction. So go on a shopping spree before year end. Now, if you buy that new Mac on 12/31 by credit card, that's not good enough. You got to receive it and place it into service. So get it done before the end of the year with quick shipping to place it into service. Now, itemized deductions are a whole different story. Now is when we get into talking about the TCJA, the new tax law. When we look at all those itemized deductions that were curtailed. So the biggest one was the miscellaneous itemized deductions. The new law suspended all miscellaneous itemized deductions that are subject to the 2% floor. Remember, you used to have to only deduct what was over 2% of your adjusted gross income. They just got rid of this thing altogether because they also modernized and relaxed AMT. So this goes hand in hand with that. So if you're paying investment fees and expenses, you have an outside manager, you can't deduct that here from on a taxable basis. If you used to deduct unreimbursed employee business expenses on Form 2106 for your car, your professional licenses and tools and uniforms and all that, you can't deduct that anymore. You used to pay our fees, tax compliance as an investor. You can't deduct it anymore. Our clients deduct it with trader tax status. So I've written extensively about it. Look at those blog posts. Now, so let's start with talking about the investment fees. Keep in mind, there's not just the regular tax, there's the net investment tax from the Affordable Care Act. Investment fees and expenses remain deductible for calculating net investment income for the 3.8% net investment tax on unearned income. So if you make a lot of money, if you're in the top 1 or 2% of taxpayers, and you're over the threshold, so the NIT only applies to individuals with net investment income and modified adjusted gross income AGI exceeding $200,000 if you file single, $250,000 if you file joint, or $125,000 married filing separate. So if you make $300,000 a year as a trader and you're single, well, that's over the 200 AGI. So you're 100 over. And if that whole 100 that's over is from unearned income, trading income, net of trading expenses, then it's all subject to the 3.8% tax. And that's going to cost you $3,800. So what can you do about it? Well, you can do strategies to get your AGI under the threshold, like maybe a big retirement plan deduction would get you under that. Maybe some tax loss selling will get you under that. So by getting under the AGI limit, you get out from under the NIT, the net investment tax. But if you're in the NIT zone and you're just stuck with it, you're over the AGI, you have some net investment income. I mean, this hits people just with a job. It hits them on their dividends and interest. Well, don't lose track of your investment fees of expenses because you can deduct them on this form, the 8960. Now, the IRS does not index those thresholds, those AGI thresholds for inflation. So as we get into more inflation each year, those are going to grab more and more people. That's how, remember that AMT patch every year they used to have? That was because of they didn't index for inflation. A lot of things they index for inflation, a lot of things they don't. You always got to know whether they do or whether they don't. So back on those investment fees, suppose you have, you have your IRA, you have your taxable account, you have an investment manager. You still may be a trader, but you also have investments. Well, don't pay the advisor who manages your IRA or your qualified plan from your taxable account where you might have used to take a miscellaneous itemized deduction. That's gone. Try to find a way to pay the advisor from inside the retirement plan. Now, only do it for traditional plans. For the Roth, there's no sense paying a fee from inside the Roth because you're not getting a long-term deferred deduction there and you're just using up some of your Roth assets. Don't do that. But for your traditional IRA, try to pay them, the advisor, from inside the traditional plan because it's a deferred, it's a postponed tax deduction. That's better than no deduction at all. Now, if you have a online account, let's say, with Fidelity or Schwab, or I'm not sure if Interactive Brokers offers this, and you have their wealth management service that's managing your retirement account, they'll let you pay the wealth manager from inside the IRA. But if you have an outside manager, they may balk at it. So you might want to consider having a custodian or intermediary who can be more accommodating on these expense payments. Now, I know right off the bat, as soon as I said this, a lot of you are going to think, wait a minute, maybe I can pay myself as an investment manager. Well, don't allow your retirement plan to pay investment fees to you or close family members, because that's a huge problem. It's self-dealing. It's a prohibited transaction in the eyes of the IRS, and that can blow up your IRA and make it 100% taxable right off the bat. Now, if you don't have TTS, consider trading in your retirement plan as well. So, because if you're trading in a taxable account, you may have computer expenses, or you may even have a Bloomberg if you come off of Wall Street. That's pretty expensive. You may have some trading education. And you're pretty much trading a lot in your IRA and taxable. Maybe do more trading in the IRA and maybe have some of those expenses reimbursed from the IRA. So be careful on how you do all this, but look into it. Now, if you have the job for, financial services, IT, Silicon Valley, wherever, ask your employer now, ask them right now, go to the HR department, say, if you don't know this already, hey, do you have an accountable plan for reimbursing valid employee business expenses? It will be real tough to get reimbursed for home office, but a lot of you are working remotely for the convenience of the employer, and they will reimburse the home office, and that can work out for you. Ask them about it. Ask them about flexible spending plans, all sorts of employee benefits. A lot of them were curtailed also in the new tax law, but education benefits, but they are still there. And a lot of your employers are C Corps and they offer these to you. You're not, even if it's an S Corp, you're not a 2% owner or more. You can get these fringe benefits. So look into that. And once you find out about it, you need to use it or lose it. That's an accounting quick phrase before the end of the year. You can't go to them in January and say, hey, reimburse me for December. It's got to be done before the end of the year. Now, if you're a TTS trader with an S Corp, which is what we promote the most, you're going to do your year-end payroll. You're going to do your solo 401k. We cover that next in the December 5th session. But you're an employee of your own S Corp. We gave you an accountable plan to use. Now is when you need to use it or lose it, including the home office deduction. Now, TTS traders, they allocate a portion of tax compliance fees, preparation and planning. That's what compliance means, year-end planning, preparation. They allocate it to business use. So they may pay our retainers before year-end, do year-end planning, and get a business deduction this year. Now, if you're a short seller, and I know it's tough when in a bull market, it can be expensive in the short covering rallies, whatever, but it's also, we have a lot of short sellers as clients. Some of them do great. They have borrow fees. They have other short selling expenses. Well, the borrow fees, other miscellaneous deductions. They're not subject to the 2% floor, so they were not suspended between 2018 and 2025, like all the other miscellaneous itemized deductions were. So you're still allowed an itemized deduction. However, if you're using a standard deduction, it's not going to do you any good. But it might be what gets you over the standard deduction amount. Now, if you have trader tax status, those borrow fees are business expenses. And look at this article here. We explained how other short selling expenses could be part of investment interest expense or part of capital gains and losses. Look at that. Now, speaking of investment interest expense, the good news is that the new tax law did not change it. It's still an itemized deduction, which is limited to investment income. So if your margin interest is $10,000 and your investment income is $4,000, you're going to have a $6,000 carryover to the next year. Now, TTS traders deduct margin interest as business interest on Schedule C. So it's not investment for them. So if you have a spousal partnership TTS trading business, spouse A is active, For them, they get business interest on the K1, but spouse B, the second spouse, is non-active. Well, spouse B gets investment interest expense. That's the only difference for the non-active spouse. The non-active spouse gets TTS business expenses, otherwise gets 475, but is not going to get compensation because spouse B is not active. And spouse B can be active in administration. So the new tax law definitely did curtail business interests for larger companies. If you're a big company, yeah, there's a lot of curtailing because they didn't want to reward over leveraging, and that hit private equity. But that's not applying to our clients, the traders, the hedge funds, or the smaller hedge funds. Next, state and local income, sales, and property taxes. So some states you don't have income tax, but you got sales tax, you got property tax, real estate taxes, or other types of property taxes on cars. Think of all of that as salt. Salt in the wound is what it is. It's the most contentious provision of the new tax law. It probably contributed to the House turning to the Democrats, which is going to embolden some of these high tax states to keep contesting this provision from the tax law in court. Because what happened is that when they relieved AMT, relaxed AMT, they said, well, we got to do something to limit salt, because AMT used to be the limit on salt. For a high income payer in a high tax state, you never got a full deduction for all your salt because AMT cuts you back. So now the new tax law directly cuts you back to $10,000 per year married, $5,000 married filing separate. So it's $10,000 married or single, $5,000 for married filing separate. That's for all your income tax, all your property, sales, real estate taxes. So the high tax states are suing for this. They have all these schemes. They have these state charities or city charities that they've set up saying, hey, pay the charity and then deduct 85% of that on your real estate tax bill or on your state and income tax bill. Or they recast it as payroll tax. So the courts have so far said no go. And the IRS had said through Secretary Mnuchin, through Treasury, they've come out and specifically said they're blocking these various schemes. I don't think it's over. This is still a huge issue. It's a wedge issue for Democrats. You know that wedge issues are what sell in politics. And this is a wedge issue for Democrats in high tax states. And there was a lot of money raised over this, and they're going to continue to fight it. So I expect that this would be part of Tax Reform 2.0 if it goes through and now a new divided Congress. It won't be rammed through under the old plan and busting the deficit with all Republican control. Estimated income taxes is next. So used to be like in December, you would sit there and you would work out with your accountant. I do it myself. How much am I going to pay the state? I pay Connecticut on 12/31 to get a year-end deduction without triggering AMT, because that doesn't give me any deduction at all. That plan is kind of out the window because you got the salt cap number one and you got the relaxed AMT. So you probably don't want to rush to pay anything on 12/31. You got more transparency the first few weeks of the year where you can see all the numbers, how they came down. And you can pay your Q4 estimates on January 15th. That's the due date. Now, I want you traders to be very careful with your 2018 tax payments. I'm a conservative accountant. This year reminds me of the tech wreck, the dot-com crash in 99, 2000, the 2003 recession. There have been times, it reminds me of the crypto craze last year, where traders make a fortune. They don't have to pay estimated taxes under the safe harbor rules because they only had to cover the prior year. All they had to do was cover what they paid in the prior year. They might have done that with wage withholding, or they might do that with a Q4 estimate. And then they say, why should I pay Q4 when I can wait until April 15th? Hey, I don't even have to pay on April 15th. I could file an extension, avoid the late filing penalty, only have the late payment penalty. That's like a margin loan rate. And I could wait until pay my taxes in October. Well, the crypto traders did that last year. They made millions in 2018, in 2017. They didn't pay their taxes by Q4. They didn't pay their taxes April 15th. And a lot of them couldn't pay on October 15th because crypto had really corrected, had gone through a kind of a crash. This happened with the dot-com back in the 90s, 2000. So I want you to set aside some of that tax money. I think you should pay it when you owe it. Maybe not 115, but pay it 415, because I think you're risking a lot to risk it in the markets. So understand how it works. Now, I'm not saying to every trader, pay Q2, pay Q3. I wrote a really good blog post that got a lot of hits on Forbes, talking about maybe skipping Q2, waiting on Q3, because you kind of want to see what happens going into Q4. You could have a great Q2. Remember, estimated taxes are paid quarterly. You don't have withholding on your trading gains. Therefore, you probably owe estimated taxes. There are safe harbor exceptions covering the prior year. If you left a job in 2017 and didn't have the job in 18, you might not be able to use a safe harbor because you had high withholding the prior year on your job. If it's the reverse, it could be the opposite. So now is when you're squaring up on estimated taxes and deciding, do you pay anything before you're into the state? Probably don't have to, but maybe you do if you haven't used the full SALT limit of 10K. What do you pay on 115? What do you owe on 415? What do you want to risk with a late payment penalty after that? So work with your accountant. We provide our clients with vouchers. We encourage them to communicate with us during the year. So again, in prior years, you had that whole AMT exercise. That's not really kicking in this year. But if you do trigger AMT, watch out for preference items. Look over the AMT form and see what preference items might be triggered and how to defer them. But hopefully, you're not going to see that nasty AMT this year on your tax return that you saw in prior years. Again, do the standard deduction planning. It's roughly doubled. And they got rid of the personal exemptions that's kind of built into the standard deduction. But they did beef up the child care credit, but that's got your AGI limitations. So again, the standard deduction is 24 married, 12 single, 18,000 other taxpayers. Find out what filing status you're in. If you're older or blind for the age, there's the additional 1,300. Many more taxpayers are going to use the standard deduction. I think the Tax Foundation was projecting 90%. So that so-called postcard tax return, you got a W-2, you got a standard deduction, you got a postcard return with very few supporting schedules. Our traders don't have a postcard return. Investors, I mean, with all the trading going on, tax treatment, all the issues, 60-40, ordinary, capital, wash sales. I mean, our traders are still very complicated taxes. Trader tax status is a bit complicated, but boy, does it pay off for you to deal with it. Your savings. So yeah, you might have the standard deduction, and that's great. Now, that doesn't mean that you should stop tracking your itemized deductions, in my view. Sure, it might be more convenient to do so, but it might cost you because there may be impact on your state tax return. There may be relief from other sections of your tax return, like that net investment tax that I was talking about before, saving that 3.8% tax, saving a 5 or 10% state tax. It can be a nice savings to keep track of it still. So look over what was repealed, what was curtailed. Understand when you spend money, are you getting a benefit? Are you not getting a benefit? The mortgage interest, that's been curtailed. If you're going to buy a home and you're way over the limit, you're not going to get a deduction. If you got a new home equity loan, you're not getting the deduction. Understand what is deductible and what is not. We've had all this. It's on the Tax Foundation site as well. It's in our prior blog posts. Now, let's just take a break for a second for me to drink something, and we're going to talk about this big issue, the 20% deduction on QBI. This deduction might be one of the most crucial new tax law changes to consider for 2018, and you should take action before year end in some cases. The IRS recently issued proposed reliance regulations, so we can rely on them even before they're final, for TCJ's 20% deduction on qualified business income and pass-through entities, including a Schedule C, the S Corp, the LLC partnership, the general partnership, the limited partnership. So whether you are an entrepreneur with your own pass-through entity, or you've invested in someone else's pass-through entity, private equity fund, your brother-in-law's restaurant, a master limited partnership. If you're involved with a partnership, a pass-through entity, real estate, private equity, TTS trading, a hedge fund, you want to find out. You're going to look this year on the K1. This is a new item, the K1, and you're not going to get the K1 until tax time. And it's probably going to come late and cause you to have to file an extension next year because everyone's going to be struggling with these things. The K1 is going to show qualified business income, just like in the past it showed self-employment income, whether you had that or not. So it's going to show you QBI, and it's going to show the factors that are involved in the QBI deduction, like for the wage limitation and the property limitation. Ultimately, you're going to get these K1s, and you're going to enter the K1 numbers right into the tax software that you're using or your CPA is using. And you're going to have to use tax software because it's just so complicated. Well, you're not on an individual basis. It's an aggregate, the QBI deduction. So it's actually looking at all of the QBI factors. Maybe one has a lot of wages, maybe the other has no wages. Well, the one with a lot of wages gives you all the wages that you need. So it's an aggregate. How the heck are you going to figure all this out before year end? You're not going to figure it all out before year end. But what you can do, if you're an entrepreneur with your own trading company, your own real estate business, your own consulting business, your own engineering business, a lot of our clients have all those types of businesses in addition to being traders, or their spouse has such a business. You want to kind of look at it and say to yourself, well, wait a second. I know there's a lot of limitations involved here and haircuts. Bob's been telling me about that all along. I know it's on the lower of QBI or taxable income, so that's one threshold that's kind of overall. And I know on the QBI itself that if it's a service business, a specified service activity, I'm kind of going to get limited here and hurt here. I might be priced out of this deduction. So if I know going into year end that my taxable income is over the threshold for single or married, I'm well over the threshold. And the only businesses that I'm involved with are service businesses like trading and investment management. Then I know I'm priced out of the deduction. I'm getting nothing, zero. So I don't need to sweat the details on year-end salary and other wage factors. I'm just priced out of it. I'm not getting QBI. Now, our clients know that if you have an S Corp, you're still doing the year-end payroll to unlock the health insurance and the retirement plan deduction. Those are really important. That gets you under AGI limits for unlocking everything else too and lowers taxes. So the proposed regulations, they clearly confirm that traders are eligible as a specified service activity. So they're not going to get unlimited benefits at all income levels. If they're over the income cap, they're out of the deduction. Hedge funds eligible for trader tax status, same thing. They're service business. Or investment managers, their management companies are a service business. So they see they're priced out, they're priced out. So the taxable income cap for assessing that is 415K married and 207.5K, 207,500 for other taxpayers. Now there is a phase out range. This is not, you go over the income cap, you lose it all. There's a phase out range of 100,000 married, 50,000 single underneath that income cap, where it's phased out. So if you're, let's say, if you're married and you're 20,000 under the income cap, well, you're losing 80% of the benefit. You're only getting 20% of the benefit. And also, the W-2 wage and property limitations also apply in the phase out range. Now, I'm not expecting any of you to, even though we've covered this many times, you don't have to master it all. You just have to know, hey, if I'm in the phase out range, then the wage factor and the property factor kick in. And if I'm a trader, my capital's not property. It's really only equipment. I'm not going to have enough equipment. That really works for a real estate business. So it's the wage limitation. So I'm using the 50% wages. So if I'm in the phase out, I might want to do a little wages going into year end. If you don't talk to us, we can't figure it out with you. So this is a tricky thing. You can do a lot of planning and come away with not a lot of benefit. You could do no planning and you may have been priced out anyway. I recommend you speak with us before year end, so at least we kind of take a big picture look and then decide if we want to go further. Now, that's the ranges. So again, like married, the taxable income threshold is 315K, then the 100,000 phase out, and then the income cap 415. Now, one second, I skipped the wrong way. Hold on. Now you got to have qualified business income. That's the next thing. So you're a specified service business and you got to have qualified business income. And they said capital gains are not qualified business income. They said Forex income, even though it's ordinary, it's not qualified business income. But they never said anything about Section 475 ordinary income. It's not expressly excluded. And we took a deep dive on this and make a case in this blog post, how traders, hedge funds, and investment managers can qualify for the new 20% QBI deduction. We make a case for why we think it's includable in 475. So in all our content, we say likely included, but it's not a guarantee yet. We're going to wait for the final regulations and see if we make the cut. A non-service business. So if you want to be extremely conservative, you might just say, well, let's assume that I don't have QBI. I'll wait till there's more clarity before I do any planning on it. Or if you want to take a position, hey, I have my S Corp anyway because I want my health insurance and retirement plan deduction. And that's going to set me up for the QBI deduction because I have 475. And we'll see how it works out. So I didn't tell anyone to go into the S Corp just for the QBI deduction. I said to do it for the health insurance and retirement plan, and hopefully the QBI is the icing on the cake if you don't make a fortune and get priced out of it. One second. Now, what if you also are involved with a non-service business? You're involved with a manufacturing operation, a restaurant. It's not a service, but a real estate business that's in the business of real estate. Well, the new tax law was really intended to favor those non-service businesses, and with the wage limitation to hire more people. That's why they call it a Tax Cuts and Jobs Act. So the W-2, if you're non-service, the W-2 wage and property limitations apply above the TI threshold of 315. That's the original threshold, 315 married, 157 500 other taxpayers. And then the phase out goes above that of 150. And the IRS will adjust these income caps, phase out, and thresholds for inflation every year. This is one of the things that they do adjust for inflation, and it's done on an aggregate basis. So, year-end planning for QBI. You might be able to increase your QBI deduction with smart year-end planning. If your taxable income falls within the phase-out range for a specified service activity, you might need wages, including compensation, to avoid the 50% wage limitation. You want to try to defer income to get under the TI thresholds to get this deduction. So if you could do some tax loss selling that gets you under the thresholds, you can bring into play this QBI deduction. And you might even bring in some of those other AGI dependent deductions. Filing status is a big issue this year. You remember the married filing, the marriage penalty. Every year, couples would say, should we get married in December or should we wait until, the springtime of next year? Because if we get married, are we going to pay higher taxes? Because if we file separately, we're definitely going to pay higher taxes. But are we better off being single? That's the so-called marriage penalty. They've tried to fix a lot of that with the new tax law. And the way they've done that is they've fixed inequities in the brackets for filing status. So if you look at the ordinary tax brackets, married filing joint versus married filing separate, they're exactly in half until you get to the top rate of 37%. So then it's 600 married, 300 married filing separate. So there's no inequity there, but the inequity kicks in again for single because the top rate kicks in at 500 for single, whereas if you were married filing separate, it didn't kick in, it kicked in at 300. So they jump you into the top rate a little faster if you're married than if you were single. What does that mean for a lot of clients? Well, for a lot of clients, just every year file joint. When we looked at the software and we enter information separately into the software, it almost inevitably showed that it would cost you a lot more to file separate. Well, I mean, you're not going to say, I'm going to get divorced before you're in and file single. But what you can do is when you're filing your return, just hit a button, file separate, file joint. A lot more people will file separate. Think of the QBI deduction. The QBI deduction might work for you because you're filing separate. You're an entrepreneur. Your income's not high. You're not priced out of the deduction. But your spouse with a huge job would price you out of the deduction if you file joint. So you might want to file separate this year. Also, your kids are going to have a lot more complexity filing kiddie tax returns because they've changed all of that. So you might have gone from one complicated return with all these juicy deductions to Trump's postcard return that's not really a postcard. And now you got 3 of them. You got 4 of them. You got one for you, your spouse, Johnny and Jill, the kids. Where's the simplification there? I just don't like it when they say simplification. We got all the AMT issues. We got the Affordable Care Act taxes. We got now the new tax law factors and all the changes to deal with. Where's the simplicity? So if you can save $5,000 or $10,000 filing separate, and it costs you an extra $500 of tax compliance fees, that's worth it. But if you got to figure it all out on your own in TurboTax, it can drive you up the wall. I was looking at the kiddie tax, but we're going to talk about that more later. They totally changed that with all great intention, but it's more complicated. So it is wise for each spouse to enter their separate income gain or loss and expenses into the software and to do year-end planning as well. Now, it's tricky in a community property state where there are special rules for allocating income between spouses and for domestic partnerships as well. So there are also miscellaneous considerations for individuals. And we're going to go a little bit over the 60 minutes, and then we'll get to some questions, and then we'll do a hard break at 90 minutes. We talked about the estimated taxes before and the safe harbor exception. So I think we've covered this already. Now, let's say you have a job and you got your December wages and your second half of November coming up. And you'd made some good money trading and you didn't pay estimated taxes. Or maybe your spouse is the one with the job and you're filing jointly. And you don't even know for sure you're filing jointly, but maybe you do. Well, you or your spouse can go to the employer and say, listen, withhold my entire pay for December in the W-2, because that's treated as ratably being paid throughout the year. And that will avoid the underestimated tax penalty, which might be 4%. Well, it jump up to 5%. I have to check that online. All the rates are going up. You know, the IRS adjusts rates quarterly with super low interest rates the last few years. Traders are looking at this, hey, I owe the IRS money, I'm going to have interest, whether different types applied, whether it was underestimated, late payment, late filing, what the different types of interest that would apply, they were low, but now they're jumping up. They're becoming to be more meaningful, so you don't want to be late. Now, there's another way you can avoid underestimated tax penalties. If you can't do it through wages, you can arrange a rollover distribution from a qualified retirement plan, do the whole thing as withholding, and then roll over the gross amount, go into your pocket, and say within the 60-day period, I'm rolling over the whole amount. So you arranged a 20K distribution, and the whole 20 went into federal withholding and some into state. Then you take 20K from your savings and roll it over to a rollover IRA so that it's a non-taxable rollover, yet you got more payments into the IRS and state that were treated as being ratably made throughout the year, so there's no penalty. This is saving you 4%. If you're talking about $100,000 at different, it's an annualized method throughout the year, you might be saving $3,000 this way with this strategy. Now, passive losses have always been suspended for you. You've been involved in your pass-through entities from others. You might get a QBI deduction now, but the losses themselves were passive and they were deferred. Well, if you sell out of those before the end of the year, you unlock them. You make all those passive losses that have built up, you make them realized because you sold it. You're out. Now, don't just think you can defer income willy-nilly. The IRS has lots of obstacles for people trying to manage their income. Old-time commodity traders, they'd put on offsetting positions, and they would sell the losing side before year end and let the profits run on the other side. That jig was up. That's when they did the 1986 reform for mark-to-market accounting and the 60-40 rule, because they didn't want that. They wanted it all mark-to-market. Well, there are straddle rules and other rules that kick in. I cover that in my next session on December 5th, but constructive receipt of income. Passive activity loss rules, requirements that certain taxpayers use the accrual method of accounting. If you go overboard on charity or property or appreciated securities, there are rules. So make sure you're not triggering one of these IRS rules. Now, the new tax law does allow more businesses to be cash method, and TTS traders are cash method. So that's based on when you spend the money, when you receive the money. Now, if you're a prop trader and you're an independent contractor and you're with a prop trading firm and you earned profits for Q4 each month, and the firm offered you a payout and you turned your back on the payout and you said, leave the money in the account so I can trade more money and reinvest it, they should put that on your 1099 miscellaneous because it's constructive receipt of income. You had it and turned your back on it. Now, if you're a consultant, you're working on a project and you're entitled to do interim billing, but you decide not to do interim billing and not to get paid in December and to bill it all next year, that is okay to defer. So just don't do it willy-nilly. Think it out and make sure you can do it. Now, if you're prepaying your Bloomberg for 25K, you leave Wall Street, you need your Bloomberg, you pay your 25K in December, you have trader tax status, and that goes into the next year, most of next year, but it's less than 12 months, you can get that year-end deduction. So go over this step by step. So you want to maximize your retirement plans. That lowers your income. It lowers your AGI, unlocks other deductions. You want to it lowers the net investment tax. The retirement plan is great on all fronts. If you set up your solo 401k and you're going to do 61,000 or 62,000 next year, 61,000 for this year, you're over age 50. The profit sharing portion of that, you can pay that up until the due date of next year's tax return. You got time. The elected deferral you're going to pay by the end of January. Now, ask your employer about flexible spending accounts. Look into your health savings accounts. Make sure they're fully funded for what you're allowed to defer into the year before year end. Don't miss the boat on that. Now, if you feel charitable inclined, think about a charitable remainder trust if you give a lot of money. Ask Fidelity or Schwab about that, or any of the major brokers that have it. They have a cookie cutter product available. I'm not sure if IB does. Look, they give you the cookie cutter product online. You're socking away at 50 or 100,000, getting a deduction. And then you're piecemealing out how you're going to dole that out to charities over the years, and you're going to trade that account as well. Look into that. It's beyond the scope of today's session, but it could be something that's attractive to you. You know that billionaires, they donate appreciated securities to charity. This is Warren Buffett's big thing. He gets a tax deduction for the value of Berkshire Hathaway stock because his cost basis may be pennies on the dollar. So he's getting a charitable deduction for that huge appreciation. He's not selling the stock, so there was no capital gains taxes. So it's sort of double dipping, but then these other limitations limit him. So that he gives so much away with the billionaire's pledge that he's got to, carry it over from year to year. But this is the billionaire's game, giving the appreciated property. Now, there are rules for documenting appreciated property. If it's a security, you're good. It's the market price. But if you're giving a car, it's over 5,000, you need a certified appraisal. So if you're giving some of your crypto, you want to make sure it's properly documented. People did that last year when the price was high. So look into that. Can't do this on 12/31. You got to arrange this thing with charities before the end of the year. So if you got SALT at 10K and you got a mortgage, you're probably getting some benefit out of your charity if you're a big donor. But forget those miscellaneous itemized deductions. Those are gone. You got your borrow fees in there. Look over your Schedule A. See where you stand on your charity. Even if you don't get a tax deduction for charity, it's still a wonderful thing to do to help others. Retirement and charity. This is another angle. If you're age 70 and a half, and there's an April 1st rule the next year. I have that in my blog post to go into it in more detail. But you got to start taking required minimum distributions from your traditional IRA, not your Roth, but from your traditional IRA. So you take your RMD, it's taxable income. Then you make your charity, only you don't get a benefit because you're doing a standard deduction. That's not good. There's a fix. Consider directing your retirement plan to make a qualified charitable distribution, a QCD. It's going to satisfy the RMD rule. So it's good. It's going to say this was effectively a RMD, and it went directly to the charity. Now, you're not getting a charity deduction, but you don't need one. You're going to still use your standard deduction. So in effect, you absorbed the RMD income. So it was the same as if you had an RMD income and a charitable deduction above the line. It's right, it's effectively above the line. It's a nice thing to do, but you got to arrange it before year end. That's why we're talking today and we're not talking on 12/15. Now, there's family planning to do. A lot of investors and traders, some of them have a lot of money. They get the money into the hands of the kids. They want to do income shifting to the kids. They want their kids to learn the value of money to then be able to pay their own college. They figure they're not getting financial aid. They're not playing that game. It's a different game. So, if the kids are under a certain age, the kiddie tax rules apply. It used to be that there was a certain exemption. There was tax at the parents' rate. You could put it right on your return, tax at the parents' rate. That's all gone. The kids have to file their own return, and there's the trust rates. It's not the parents' rate. It's kind of the same thing. It's on the one hand, it's simplified, but on the other hand, much more complicated. But definitely a great thing to pursue. Just learn the rules and see how it works. It will come as a surprise to many of you this year. It will come as a surprise to a lot of tax preparers, and the software will be strong on this. It will be a little tricky with planning. Also, the 529 savings plans. It used to be just for the higher education. They were relaxed with the new tax law, and now it can also pay for elementary and secondary public, private, or religious school up to $10,000 a year. So look into those plans. The estate tax, the death tax. It used to be a much, much lower number. The Republicans wanted to repeal it. They had to make a deal with the Democrats to have something reasonable. So it's at 11.18, and it jumps up every year per person for each one in the marriage, and it's portable from one spouse to the other. And they kept the step up in basis. So remember the story of Steve Jobs. I don't think he sold any Apple stock. It all ended up with his wife with step up in basis, and all that stock in Apple, they never paid any tax to the government. It never happened because of the step up in basis. This all turned tax planning upside down. A lot of people used to transfer assets out of the estate to avoid estate tax into the children. And then there was no step up in basis. And then the children got hit with a capital gains tax. It got flipped upside down. You'd rather leave it in the estate and get the step up in basis, except if it triggered estate tax in your state. And a lot of states had exemptions of 1 million, 2 million. Well, a lot of those states have now caught up with the new tax law, and they've jumped up the exemption. If not matching the federal yet, it will probably match it by 2019. So I've covered this on our blog, but look at the latest rules in the state, because there's been a lot of dynamic updating of states to be competitive. They don't want to be a death trap state. They want people to feel comfortable to stay in the state even as they age. A lot of traders want to hire children. Could be a great idea if they really do the work. If you want to do family planning with us, we have all sorts of client letters that get into every one of these issues. We can work with you on this. So come over, look at the other blog posts on our website. Sign up for the next webinar for next month. It's going to be on our site and the IB site. We're going to get the closing remarks, so you want to give us a call, 888-558-5257. Send us an email, info@greentradertax.com. I want to go over to something else to show you here. This is a year-end planning letter that we send to our clients. If you want this type of thing, email us. There's a few more things to stress that I have here in yellow. That long-term capital gains rate is great. It showed you what the brackets were. I think we kind of did go over most of this. So we'll go back to the website. So let's look at some of your questions. So go to contact us. By the way, here was that Forbes post that had a lot of viewers on about the underestimated penalty You can find that usually on our site on the blog listings. So let's get to questions.
And while Robert's reading those questions, I'd like to remind everyone the control panel that's located on the right-hand side of your screen includes a questions title bar. If you simply double-click that title bar, you can type in any questions you might have for Robert at this point. Thanks. Back to you, Robert.
Okay, thank you, Cynthia. And I'm opening the questions now. Okay, here they are. I'm sorry. 1 second. All right, I don't see a lot of questions on the board, so get them on quickly now. Yes, this is for the U.S. taxpayers, for you non-resident aliens. We had a wonderful webinar last time around, so check the recording on our site or the IB site. Phil A is margin interest deductible. Yeah, we covered that, Phil. I think you had asked it before we got to that slide. That still is an itemized deduction. It's limited to investment income. But again, if you're doing a standard deduction, then you're not getting that benefit. Hugo M, I have an LLC for my software company. If it's a disregarded entity, it's on Schedule C. I'm also under TTS. Do I have to operate another LLC? Well, you don't want to do your TTS, trader tax status trading, under your software company. You want to keep them as separate businesses. Now, you might not need an S Corp for your TTS trading if you have enough earned income from the software business, because you're going to need reasonable compensation on that in that S Corp. So we don't recommend trading in your other business because it confuses the IRS on the trader tax status, and it puts pressure on you for reasonable compensation in S Corps. Mike L, I'm only using last initial to protect people's privacy. Mike L, can your company help me if I'm a U.S. expat living in Ireland? Yes. So U.S. expat means U.S. resident abroad. If you have a S Corp out of Delaware, you can arrange the foreign earned income exclusion and housing allowance and the retirement plan deduction with the year-end payroll. So we can do all of that with you. That's covered in our guide. So you want to follow up with me after you read our content on that. Under our Trader Tax Center, click on International Taxes and read about that. I don't really like the idea of the international business, the IBC in Belize. We can talk more about that. It can be a real problem and red flag and not give you any tax breaks. So when it comes to offshore entities, it can be a whole heck of a lot of cost and red tape and no tax avoidance, no tax deferral at all, and almost, inviting the IRS to take a look at your situation and a lot of compliance fees. So don't go offshore to try to cheat on taxes, to try to save taxes. It's not really going to work at all, and I'll explain to you why. That being said, there may be a valid reason to be offshore, to gain access to certain offshore markets, to manage accounts for offshore clients, but you want to do it properly and with good counsel and not in any way to cheat on taxes or to hide. Craig N, can you qualify for TTS if only have 1256 trades? Yes, you can, Craig, and you can get the benefit of the 60/40, but also all the business expenses. Hugo M, I have an LLC. I think we just answered that one, Hugo, already. Thomas L, are non-U.S. persons taxed the same? No, you want to go to that last webinar. So you go to the website. Let me just show you around two things here. So you would scroll down on blogs. So you would come to our website, you'd go to blogs and events. You'd click on events in this case. And you'd scroll down to a prior event and you see how non-U.S. residents save U.S. taxes. You'd click on that and you click on the recording, and that would take you to the recording we did with IB. And also, if there's a recording, there's probably also a blog post as well. So you would scroll down and you would see how to save U.S. taxes for non-resident aliens. So you want to go to that. That's got all the answers to all those questions. That's why we did it, because I know IB has a lot of non-U.S. person clients. So Nicholas T. I'm a W-2 employee, but day trade in the morning before work. Can I qualify for TTS? Yes, you can, especially if you live on the West Coast and you wake up early and trade the morning session before going to work, Pacific time. But you can do it East Coast too, and maybe you trade futures at night. Maybe you trade Forex at night. Maybe you have flexible hours at work. We have clients worldwide who qualify with other businesses. It does not have to be your primary living. It can be a secondary living. Sydney A. What should a new 2018 trader do? Well, if you started your TTS before today, I mean, starting on Q4, you can claim it on a Schedule C. And then you can also get Section 195 startup costs going 6 months back before that. So we can plan to add a Schedule C to your tax return and get a lot of these business expenses, including some of your your startup, which might include education. And we're going to talk about all those unique trader year-end planning issues on December 5th in our next webinar. So sign up for that one today. Sam M. If not TTS, can you defer income? Sure, there's all sorts of ways to defer income. Don't sell winning positions, sell losing positions. That's the one way to defer income. Try to defer other types of billings and other income. We went through that. Alan K. When is the webinar? December 5th. Go to our website and see on this events page right here. So go back to the events page and you'll see it right there. Now, by the way, we got the expo coming up as well. So those two events and then the December 5th. I recommend the expo webcast if you're not going to be there. Richard B. Or MTM trader gains and losses part of the net investment tax? Yes, they are. Whether it's MTM or capital, it's all part of your net investment income. And if you remember, we fought with the IRS to get your MTM losses allowed in full, no matter what bucket they were in, to get all of your expenses deductible. We won all that. That advocacy really paid off. So we have that covered in our content. So go to the Trader Tax Center and click on the Obamacare or Affordable Care Act. JPP, I am TTS and MTM under SP. Not sure what you mean SP. I plan to create an entity, or single person maybe you mean. I plan to create an entity for 2019. That's a good idea. It's a little late now to form the entity because it wouldn't really get going and then the window's kind of closed. So you're really thinking about getting it going for January 1st and all the planning that's involved with that. And we cover that on the December 5th webinar. So come back on that one. Why is the S Corp ideal for the trader? Because then you can create the wages you need for the health insurance and retirement plan deduction that the sole proprietor and partnership trader cannot. And we cover that on the next session. Mike L. Thanks. Okay, I appreciate it. All right. MK. Question on passive loss rule 475 elected business. Well, a trading business is exempt from the passive activity loss rules under the trading rule. So you don't need material participation. It's entirely separate. It's not the passive activity. Hugo M again. I have lost money overall. I have to pay taxes on the gains. Well, if you have a huge capital loss carryover or year-to-date capital loss, and you're holding on to a bunch of winning positions, and you were thinking, well, I don't want to sell those winning positions because I don't want to pay taxes, you're not going to pay taxes. You're going to soak up the capital loss carryover. So if you feel like don't hold for a long-term capital gain, there won't even be a taxable capital gain. It's going to be soaked up with the capital loss carryover. So if you feel like the market may drop now and you think the price is a good price for you to sell now. Don't wait. So think out carefully where you stand on capital gains and losses, 475 ordinary gains and losses. A lot of people get confused about it and make the wrong decisions. They hold longer than they should. They don't realize they can sell now. Now, I'm not telling you to sell now. There may be this great year-end rally. I don't know. I'm not an investment advisor. I'm a conservative accountant. WZ, when Z. Do you have any comments comments on loss limitation rule. Yeah, I cover that in the next session about the 500K excess business loss rule for married, if that's what you mean. I'm not sure what you mean by your question. If you sell Apple stocks and have a 1 million long-term capital gain, yeah, if you have a 1 million long-term capital gain and you have an ordinary loss of $1 million, well, you're probably going to have the excess business loss of 500 on married. So then you'd be stuck with 500 long-term capital gain, and you would get that lower rate of probably 15 or 20%. So yeah, the excess business rule might be good for you. You may like it because it brings into play the long-term capital gain and it defers the NOL for the excess business loss the next year. I think that's a pretty good deal for you. It's funny how things can work out when they, a so-called limit actually ends up helping you. There's always perverse effects. It's freakonomics, tax freakonomics. Nicholas, for that book about, when you wanted to have an incentive to do that, and it has the reverse effect. The Dubner and I forget the writers' names, but those are good books, freakonomics. Because I think about tax policy with carrots and sticks. It really does apply. Nicholas T. I live in California. Well, yeah. I mean, there's a high tax rate, no estate tax, but a high tax rate. But and they've had limitations on NOLs before and NOL carry forwards, but a lot of people live there. And I've had a lot of clients move out of California to Puerto Rico to not pay any taxes. Only then they didn't make any money, and they wish they stayed in California. You never know how things work out. Nick B. But that being said, a lot of people are moving out of California. We do consult them about it, and the state doesn't give you up so easily until you establish domicile in that next state, and they're pretty strict about it. So if you're going to leave California, do it lock, stock, and barrel. Consider an economic nexus in all the court cases. Nicholas T. I live in Cal. All right, I already did that. Nick B. How do we get TTS? We've had other webinars on that. Look at the recordings. And a lot of stuff on our website about that. 4 trades a day, 4 days a week, holding under 31 days, 4 hours a day. Margaret T. How would you lose TTS? You'd fall below that, Margaret. You'd have that all, and then you just stop trading. So you could use trader tax status until you stopped. Use mark to market when you stopped, and then you revert to no MTM afterwards and back to investment expense treatment afterwards. It's assessed. You put the bread in the oven and you keep looking at it when it rose, when it drops, and it's based on facts and circumstances. It's not based on elections. You don't elect trader tax status. You claim it. You do elect 475. Trader tax status is undergraduate school. 475 is grad school. They're separate but related. I'm going to jump to some other questions here because I see a lot of people with follow-up questions. I want to give everybody a chance because we're doing a hard break at 1:30. Phil A., I moved from California to Nevada. Yeah, that's great. I mean, Nevada has the new commercial activity tax, but a trading company is exempt from it as a passive entity. You could have your LLC in Nevada with the S Corp in Nevada, but you're out of California, lock, stock, and barrel. A lot of double up questions. You may want a consultation with me. That's a good deal. We cover everything. We go over your year-end planning and all this stuff. LG, sound loss. It should be back. I haven't seen anyone else say the sound is not working. Go back to the recording later if you lost your sound. Sam M. I've done lots of short-term buy and sell stock. Also have W-2, 1099. Can I defer income? Yeah, look at what you have. I mean, if you got futures, that's MTM. It's mark to market. You don't need to do tax winning or tax loss selling. If you have 475, it's MTM. But the stuff that's not MTM, you're sitting there with either unrealized gains or unrealized losses. And what do you want to do? What's better for you? Do you want to round off a bracket before you get into the next bracket? Do you want to get lower into the lower bracket? I mean, really, you have a chance to do a little customization. Now, don't have the tax tail wag the dog because it can be a mistake. I mean, what's more important is the markets, is the income, is the business. Taxes come second. Sam M, I've done lots of, I think I answered some of your questions already, Sam. James B, the recording, you'll all get the recording. Eric F. Yep, you can get the whole recording. Craig, the Q&A, I believe that the Q&A is in the recording as well. So let's go back to the website. I didn't answer all the questions because some of you had duplicates, but let me show you around a little bit here. So you got the tax center. So you would scroll down and you would click on the international tax matters, the Obamacare, we had talked about that, tax planning. You get onto that webinar for the next webinar coming up, the Expo and the IB webinar for the traders have unique issues for year-end planning. I would suggest a consultation with me. Click on consulting. You can get on my schedule usually within a day or two. I would suggest you sign up for year-end tax compliance. Start that process. It's a 15-minute client evaluation. Start that process. You're assigned a CPA if you're an ongoing client. Sign up and work with your assigned CPA in our firm to do the year-end planning. We can do the year-end accounting for you. So all that being said, I think it was a good session today. Go back and listen to the parts of the recording that you want to. You'll see the slides in that recording. I think as a bonus material, you can download the slides as well off the IB site. So thank you everyone for coming. Thank you, Cynthia, over at IB, and back to you.
Okay, well, Robert, thank you very much. Very interesting material here today. And as you mentioned, we have been recording the session, and each of you will receive a direct link to today's recorded playback for on-demand listening. But also notice in the follow-up message, we do include a PDF copy of today's webinar notes. So you can even get a copy of those slides, as Robert had alluded to. Also want you to know that we do have the December 5th event posted on our website as well. You can find not only today's webinar, but you'll also find any of the previous events that Robert had done going to the education menu. Notice there's a webinar section, and click through, either sign up for our live events, upcoming events, or go and search. You can filter by Robert Green to find any of his previous webinar recordings. So with that, we will end today's session. Once again, thanks so much to Robert Green for all the information that you've provided today, and for coming back on December 5th for the second part of this series. So with that, we are going to conclude our event today. You can all exit the session using the X in the upper right-hand corner of your screen. Have a great rest of your day, all, and we'll see you next month. Thanks, everyone. Have a good one.